Hey, this is Trader Travis, and in this video, what I want to do is my year-end review video where I cover the performance of the stock market as well as my performance as an option trader or the performance of one of our students. Now, what you're about to watch in this video is why I'm on a mission to encourage everyone I know to learn about option trading, because online option trading has been for years one of the biggest secrets of investing. And in recent years, normal people like you and I, we now have access to the tools of the wealthy, and we can earn anywhere from 2 to 5% return on our money each month. Now, the belief that stock option trading and those type of returns, are too good to be true, this kept, tons of people from realizing the full potential of their investment portfolio. And I want to change that. So today I want to review my portfolio performance for 2012 and compare it to how the stock market did. Also want to dismiss a few option trading myths. Now, the myth versus truth I want to talk about in this video, they're just my opinion, and they're my opinion based on my 10 plus years of trading options. It doesn't make it right or wrong. It just makes it my opinion. Now, the trades you're about to watch in this video are trades that I made within the 50K group. They're actually 50K group trades. Now, the 50K group is actually a year-long mentorship program where graduates of our coaching program get to peek over my shoulder and they watch me analyze the markets as well as trade my own accounts. And so before I cover all those trades, let me go ahead and do a quick recap of the stock market's performance in 2011. And I'll cover that in more depth in last year's year-end review video. But in January 3rd, 2011, the S&P closed at 1271.89, and a year later, on 12/31/2011, the S&P closed at 1257.60. And so what you had was that the S&P essentially had a loss of $14 for the entire year. Nothing happened. I mean, the S&P pretty much ended the year flat. But I know for a fact of several people who did much better than the stock market last year. And back last year, I actually received an email from one of my coaching students, and I actually interviewed him. And his interview is actually inside the members area of our coaching program. But his name is DJ. And he sent an email. He's just saying, happy 2012. And this was in response to the email I sent about the top 50 stocks to trade right now based on a report that Market Club has sent out. And I'll be real quick here. He just had a little small talk at first, and then he put this as if it was no big deal. He says, also, thanks. I ended up increasing my options portfolio by 30% in 2011, but of course, it's not a true 30%. And I never had the full amount vested at any one time. It was all from small trades, of course, money management, right? And I would have to agree with him. And we're going to talk a little bit more about money management here later in this video. Now, if you're not aware by now, which I assume you should be aware, is that the S&P 500 is a professional benchmark, which means that professional money managers or, mutual funds, they actually try to beat the S&P's performance each year. And there's a report out called the Spiva Report. Jim Cramer's also talked about it, that roughly only about 10 to 20% of them beat the S&P in any given year. It's not always the same 10 to 20% either. And so what that means is that 80 to 90% of them fail each year. 80 to 90% of them fail to do what you pay them to do, but they still get paid. So, essentially the translation is they still get to take your money no matter how well they did or didn't do. But, let me get off my little mini rant here, because that in and of itself gets me pretty upset. So let's go ahead and cover how the S&P did in 2012. Much better than 2011, but still, not as good as I would prefer. On January 3rd, 2012, the S&P closed at 1277. A year later, 12/31/2012, the S&P closed at 1426. And so the S&P had a total yearly gain of about $149.13, or 11.68%. Now, this is a typo here. I said much better than 2012. But I actually should say much better than 2011. But I still think you can do much better as an option trader. Again, I just showed you DJ's performance from 2011. So now what I'm going to do is go ahead and look at how I did in 2012. Now, I traded two accounts, two model accounts within the 50K group, a $12,000 short-term account and a $48,000 long-term account. They both have two different approaches and two different goals. The short-term account is just to show people the more riskier strategies, and that account is is meant to be more aggressive. So to earn, 30 or 50% a year. The long-term account is meant to be conservative, maybe just to show people an example of how they might manage their long-term retirement account, the account where they're going to produce income to live off of. Now in 2012, I only traded from January to October. Now I'll cover why later, why I only traded 10 months, but out of those 10 months I traded, 5 of them were losing months. I also placed 83 option trades. And of those 83 trades, 44 were losers and only 39 were winners. So when you look at the numbers like this, it's a fact that I'm a loser. And on average, on an average basis, I lost more times than I won. But here's the first trading myth. The myth is you need a winning trade ratio to make money. Now, the truth is far from that. You could possibly win on only 30% of your trades and still make money. And a lot of people don't believe that. They're like, what? You lose on 70% of your trades, only win on 30 and you still make money? Yeah. And if you follow a strict risk or money management process, you can do that. Now, all of my losses were kept pretty small. Well, small in relation to my total account balance. But despite that, despite being a loser, despite having a losing individual trade ratio and a 50-50 ratio as far as winning versus losing months, I still ended the year with a $3,680 profit, or a 31% increase in my short-term trading account. And this leads me to my second option trading myth, is that if you manage your own money, you won't be able to beat professional money managers. Well, here's the truth. The truth is you could do much better. All right. Now, Warren Buffett, the world's richest investor, has even been quoted as saying that individual investors can do a better job at managing your money than the professionals. Now, I won't get into all the reasons why here, but a lot of one of the main reasons is they're handicapped by the large amount of money that they're investing. They also have regulations that require them to stay invested a lot more than you and I. We can get in and out. I'm an average Joe. Okay. Now, I want you to think about something. I'm put this in perspective. I'm an average Joe, guy who grew up in poverty. I didn't learn what the word investing meant until I was 20 years old. The guy kept talking about investing. I finally stopped him and said, what does that mean? All right. But somewhere along the way after that, I invested in my education. And what you're seeing is a result of that, a 31% increase in my investment portfolio. So if I can do it, I know you can do it. So let me go ahead and take a look at those trades here. Let me log into my brokerage account. Now, you have a paper money side and a real money side. Now, these trades were actually real money trades. So let me log in here and get this account screen set up for you. Now, I'm going to show it to you both in an Excel spreadsheet and just show you what the trades look like inside my account. Okay, so let me go ahead and find that account here. And I'm going to have to change the dates here back to the beginning of the year. So let's do January 1st, 2012 to 12/31/2012. Okay, so we have the order history here. So let me scroll all the way down here to the bottom and show you what I'm talking about, so you can just get a visual here. So you can see these trades: SWN, PA, Nike, Yum. All right, all these trades right here are in the spreadsheet. Now, I'm not going to show the trades in my account because what I use is a spreadsheet for recording purposes within the program, because it's a lot easier to look at the trades in a spreadsheet. And again, starting balance was 12,000, and it had a 31% increase in the investment account. So again, I made a total of 83 trades here, and I want to show you an interesting fact. 83 option trades, and 88.97% of my total profit came from 2 stocks. The 2 stocks I traded the most, Apple and Google. All the trades I made on Apple, they resulted, profits and losses combined, $17.90 in profit, and Google $14.94 in profit. Now, I didn't target those 2 stocks specifically. I just merely took whatever the market gave me. And so that leads me to another trading myth. A trading myth I often hear from people is that they think that you have to trade a large number of stocks because it increases your chances of making money. Now, the truth is it doesn't matter, because sometimes, trading more stocks helps and sometimes it doesn't. When I first learned how to trade, I heard a story about a guy who made $1 million trading one stock, and that one stock was IBM. I heard another story about a retired lady who only had a basket of 10 stocks she followed. Now, their advantage is they were familiar with those stocks. They had a small basket of stocks, 1 to 10. And they knew those stocks as well as a parent knows their kids, so they could easily spot trading opportunities and anticipate changes in the stock's trend. Now, let me go back. I told you why I said I would explain why I only traded 10 months out the year. So pulling up this Excel spreadsheet here, let's go to October. So let's go ahead and get rid of these last few trades here. Now, coming into the month of October, the account was up 36%. I think at one time the account was up 40 something percent for the year, but I had lost some trades. So I was coming into 36% coming into October. Now, at that point, we was coming to the end of the year, you know, holidays are coming. I decided that, okay, if I lose money and I get down to 30 something percent, I'm going to stop trading, you know, because 30% increase in my investment portfolio is bare minimum. That's bare minimum what I target each year. I was hoping to get more, and I kept trading, trying to get more. I said, I want to take this account up to 40 something percent, hopefully 50 something percent. But if I started losing money, I said I would call it quits at 30 something percent. And I did. I made a couple of boo-boos here at Amazon, and one, it just really hurt me. I made one big loss on Amazon, and then I ended with Visa and Sherwin-Williams, a couple of other losses, and that took my account down to 31%. And I quit for the year, you know, because I've learned over the years that it's not worth it pushing your luck. I could have pushed my luck and kept trading, but here's what happens. I would have been forcing my intentions on the market, and it's best that you never force your intentions on the market, because the market doesn't care what you want. The market doesn't care that I wanted to, you know, get my portfolio up to 40 to 50%. So it's best to sit back and to just let the market take whatever the market gives me. And so I've learned not to force trades because it doesn't work in the long run. And so let me go ahead. We'll touch back on the spreadsheet here in a second, but let me move on to another option trading myth. Now, that is, if I use conservative risk management, risking only 1 to 2% of my total account balance on a trade, then it's going to take me forever to build up my account. Because sometimes people read that, hey, I read online that when you place a trade, that trade should only be about 1% of your total trading capital. And people say, man, if I do that, I'll never retire a millionaire. Well, the truth is that trading frequency and profits, they often have an inverse relationship. Now, the translation of that is that the more you trade often means the more you'll lose. And the less you trade often means the more you'll make. And it's because the more you trade, you're exposed to more risk. So what I'm going to do now is load up a short segment of an old Q&A video we had in our coaching program where I was explaining this concept to students. And I went a little bit more in depth than that. So let me load up that video and I'll be right back. All right, so now let's go ahead and move on to our first question received on percent returns. Now, this will be a good one for y'all. And I covered this in one of our trade recap videos. Now, somebody said that I mentioned in one of my videos that, you know, on average, our accounts might have a 20 to 50% return on investment a year, like our entire account. Stock market on average does about 9-11%, and I was saying that as an option trader, I'm used to about 20 to 50% a year. And the first question was, is this, you know, on your complete account or just the trades? I was talking about the complete account. You know, for the entire year, we might have a 20 to 50% return on our account. You know, it's on average. It fluctuates. Some years might be less, some years it might be more, but on average about 20 to 50%. It's really, really easy. It's not as hard or as impossible as it seems. You all actually have seen that. If you look at the OPF trade section, you saw that. And I'll show you a spreadsheet here in a second. It's not that hard. Okay. Now, the second follow-up question is am I completely invested when I'm in the market? And the reason they asked this is because they were saying that if they invest only 2% on each trade and their account is 100 grand, it's going to take them a lot of trades to get their account to have a good return. And I said, no, it's actually not. Now, this is mainly talking about the short-term account. Remember, in the short-term account, you're using more risky strategies. That account where using, you know, you place about 20% of your total investable cash using the riskier strategies. And so you have to be very, very careful not to lose all your money. And so often we tell people, you know, risk about 2% of your entire account value on one trade. Now, in the money management myths section I talked about, that's one of the money management myths. People think that if I only invest 2% of my entire account on one trade, it's going to take me forever to build up my account. And logically, yeah, it seems that way, but it doesn't work out that way. Okay, so one, I can point you to the OPF trade section, but let me show you those trades right here. Okay, in the OPF trade section, I showed you, you know, you saw most of the trades we made in the beginning of the year. Okay, so starting January 17th, the last trade here, I just cut this off at about March 15th, so about 2 months. Okay, so all these trades here represented the account started at $12,000 starting balance.
And every trade we invested roughly 2% of the entire account. Or we risked 2%. So worst case scenario, in each of these trades right here, we were only willing to lose about 2% of the entire account value, which was, the account value of $12,000, which was about $200. Okay, so you take, start here. So $12,000 times 0.02. So on all those trades that we made sure that, worst case scenario, we would lose no more than about 240, give or take. It's going to change depending on the trade, about $240. All right. So we made a bunch of trades. We had some winners. We had some losers. All right. So this is only 2 months worth of trades. And, most of those you can see in the OPF trade section. Now those, 2 months of trades made about $2,600 in profit, and the account had a return of 22% in about 2 months time. Again, making 2% of your account, maybe 3 to 5 trades at a time, 22% in a matter of 2 months. Now, if you look here, this one was closed out 4.9. What happened around 4.9? Let's pull up the S&P 500. Okay. 4.9 was right here. Okay. So let's pull up a trend line. What happened? Market hit a transition period. You could draw simple trend lines like here. You know that the market was going up since December 19, 2011, right here towards the beginning. Never crossed this trend line once. Crossed this trend line, that was your first signal that a transition period was in hitting, besides the fact that we had market club, we could see the 7 cross through the 30, all that. Again, technical indicators or visual aids, all right? So let's actually clear off these study sets. Okay, so we saw that. It crossed this trend line, and this was April 9th, all right? The day we exited, all right? So that right there, okay, now, it crossed the trend line, that's a transition period, it starts there, you're like, okay, I'm going to back off now. I'm not going to make any more trades until the market resumes its downward trend, upward trend, or until you figure things out. So let's say you sat on your hands for 2 entire months. 2 months, you made 22%. Okay, you got out in April, let's say you didn't make another trade to June. And then you had and then you waited till a trend was seasoned, and then you traded from June to maybe August. Another 22%. Okay, and get that. And that's sitting out 2 entire months. Can you imagine those trade addicts that would drive them crazy because they always want to be in the market, right? So you sat out 2 months, didn't invest in anything. You came back, you waited for the market to season, traded from July to August. Okay, then maybe their account is up to 44%. And you sit on your hands again, September, October, and you come back in November and trade to the end of the year. Now you're at 66%. Okay, that's assuming you can, continue this feat, which is really possible when you trade in markets like this. You wait to really good season trend. It doesn't take you that long to make a lot of money. Heck, you could stop right here. You have squashed the performance of most mutual fund managers. You are a trading god, god or goddess in the trading industry. If people know you increase your portfolio by 22%, people will be throwing money at you, asking you to manage their money, because most people don't do that. And that's only trading 2 months out of the year. So that's why I tell people, it's a money management myth. You think that it's not possible, but it is. And another thing I tell people is the more you trade, the more you lose. It seems counterintuitive, but it's counterintuitive. That's just how it works. Because the more you're in the market, the more risk you're exposed to compared to us. We continue trading here. We crawled our way into a few trades, but regardless, we continue trading. What did it do? It hurt our performance. So this is not entirely updated. The gains are a little bit higher, but we gave back some of our profits. Why? Because we stayed invested. And when you stay invested, you're at more risk. A risk I was willing to take, but this is a proven fact. This is what I'm showing you right here. And so if you're one of those people, that can sit for 2 months at a time, you'll do okay. You don't need to trade a whole lot. That's why I put that in the money management myths lesson. And so you can, trade each trade risk, no more than 2 to 3% of your entire account value. Maybe open 3 to 5 trades at a time, spread out your risk. And you'll slowly build up your account little by little. And at the end of the year, you'll be amazed at what you do. And then when the market hits transition periods like this, you could just sit on your hands and wait, wait a couple of months till the market, sorts itself out, then start trading again. And at the end of the year, you will be surprised at what you do. And so I just wanted to clarify that because somebody asked that question. And unless you've had, as many years of experience trading as I have, you don't really know and you haven't been able to see that. But I saw and experienced that firsthand. My mentor told me that when I first started investing that, look, the more you trade, the more you're going to lose. And I'm like, that didn't make any sense to me. And I'm like, it just made, to me, I'm thinking like, no, the more I invest, the more I'll make because I'll make more trades. And he kept saying, no, you're exposed to more risk. The stock market is schizophrenic and you'll get caught. And one of the days the market decides to change its mood on you. And he only traded a few times a year, because his goal was to beat the S&P. It only required him 2 or 3 trades a year, and he was good to go. And so that was him. I don't prefer to trade at least 2 or 3 times a year. I prefer to trade more. But now, after investing so many years, I really see that he was correct. The less you trade, the more money you'll make. Doesn't make any sense, but you're seeing that. And it's because the less you trade, the less risk you're exposed to. If you wait and you cherry pick to the optimal times, then you'll make more money. Do you know would it be an optimal time and which will not? No, you don't. It's really hard to determine in real time. But that's why you use technical indicators. That's why you use Market Club. That's why you use your trend lines. And then you do your best. You make your best guess at the time. And then sometimes you'll be right. Sometimes you'll be wrong. Sometimes you'll be in the middle. But overall, you fine tune your decision making and you will do just great. So, what I tell people is, in your mind, you think that if I only risk 2% of my entire account on one trade, it's going to take me forever, to have a return of about 20 to 50%. But no, you saw this right here. Just in 2 months' time, the account had a 22% return on investment. You could be done right there. And all these trades were only risking 2%. And so, you got to think about it. 2% adds up. 2% here, 2% there, 2% there. 5 trades, that's 10% return on investment right there. If you have 5 profitable trades and each trade, you made about 2% of your account value, well, that's 10% right there. Again, that's one of the money management myths. And what traders will do is they will look at that and say, that's too conservative. I'll never make a lot of money doing that. And so they risk more of their account. They bet big. They risk 10 to 20% of their entire account on one trade, trying to hit home runs, or convincing themselves that, they have to invest that much to build up their account. And and that's totally overly optimistic, because what they are looking at is only how much they can make. They never look at how much they can lose. And when you start losing 10, 20, 30% of your account each time, next thing you know, you're looking at a pretty small account. And you can't do much with it. And you're so beat up emotionally, you usually don't recover from it. And has anything to do with trading. It's just emotionally, you can't recover from that. Well, you can, it's just hard. So they get depressed, they kind of give up, and they don't want to fool with trading. So I say, you know what? But when you lose 2%, you're like, let's say you have a $10,000 account. You lose 2% of that $10,000 account. You're like, matter of fact, let's do the numbers. Okay, we have $10,000. Okay, we risk 2% of our account on one trade, so you lose $200. You're not going to cry. You're going to be like, I still have $9,800 in my account. I'm good to go. I can recover that $200 no problem. So emotionally even helps you, and because you feel more empowered compared to, I had a strategy session with a student a long time ago. They were emailing me. They were having trouble. They had a $10,000 account, and they were like, man, I am on edge. My nerves are shot. I'm getting out trades too early. Just listening to him, I could spot it right away, because, again, I told you all, if you're struggling, send me an email, because I've been through most of what you're going to go through. Immediately, I know he was risking too much money, because when you can't sleep at night and you can't let the trades naturally mature and fluctuate, you're too stressed, you have too much money on the line. And so I said, how much are you? I said, I guarantee you using about $1,000, $2,000 per trade. He said, yeah, exactly. I said, yeah, I'd be stressed too, because you realize subconsciously, maybe not consciously, but subconsciously, that if you lose all in this trade, you're only going to have $8,000 left in your account. And there's only a few of those that, you can, you go through before you wipe out your entire account. But for me, I'm risking 200 per trade. I can have like 10, 20 trades out. I'm good to go. I'm like, I'm not worried about it. One trade is not going to knock me out the game. Compared to him, 1 or 2 trades, he would have been done. It'll take me like 10 to 20 trades, losing trades in a row before I started getting stressed. And so that's pretty much how that goes.
Okay, I'm back. Now, real quick before, let me go ahead and end this video because it's getting too long. So what I want to do is, I told you I had 5 losing months. I lost January, had a couple of profitable months, and then April, May, and June were 3 losing months in a row. Okay, came back. July and August were profitable. September is profitable. In October, I lost money again. So now what I want to do is pull up the chart of the stock market, or the chart of the S&P, and show you exactly what went on right here. So now we're looking at a 1-year chart of the S&P 500. Okay, what do you see here? January 2012 to about April. What happened in April? The market turned over. It transitioned to a downward trend. Picked back up April 30th, pretty much June, the market turned back up. Okay, when you look at my spreadsheet, what do you see? Aside from that, one losing trade in January, you see, okay, I made money February and March. April, when the market turned over, I lost money. I lost money from April to June, which was that downtrend. I started making money in June again, and the market went back up to October. And my performance was the same way. I started making money July, August, September, and in October, I lost money. Granted, I didn't trade that much in October, but my performance pretty much matched the up and down of the stock market, and probably would have been better off if I just only traded in up time. So this year, I didn't do that well trading in the little down pullbacks. And so I made tons of mistakes and still, had a 31% increase in my investment account. Now, that leads me to the next myth here. Looking at my performance, a lot of people come to me and say, well, how much would I have to trade to make $5,000 a month? Or you read some sales page online, they can say they can teach you how to make $2,000 a month or 10% consistently every month. And a lot of people believe that. But you know what? Here's the truth. Trading is like working on commission. Some months are great, some months are bad, and other months are so-so. Some months you're going to be excited because you're making so much money, you just want to make love to your significant other. And other months you'll be so ticked off from losing money, you want to throw your computer out the window. You might even feel like a loser. I'm a professional full-time trader. I've been trading almost 10 years. I lost money 3 months in a row. And it's bad enough losing money, but I had to lose money in front of all of my students. And I'm sitting here depressed on the sofa. I was like telling my wife, I'm like, oh my gosh, you're going to think I'm an idiot. She's like, are you following your rules? I'm like, yeah. She's like, all right, just stick to it. And so I got back up, brushed myself off, and leaned into it. And eventually things turned around. That's just how trading is. But some people can't get through that. Because trading is both an emotional and a financial roller coaster ride. And a lot of new traders can't get through that. They don't have a mentor. They don't know that that's the reality. Trading is like working on commission. And so because it's a financial and emotional roller coaster ride is why I don't trade options for a living, despite being a full-time trader. I trade options to build wealth. And there's a big difference between trading options to build wealth versus trading options for a living. Now, those two approaches are different. I won't have time to go over that in this video, so I'll have to cover that in another video one day. So you take care, and I'll talk to you soon. Bye-bye.